Hi, welcome back to what will be the shorter and the second of two videos where I'll be looking at the effects of errors on final accounts. What we did in the first video, we looked at the impact of errors on profits, and what we said was what's always a good idea is to jot down what the journal entries will be, and remember then that only things that affect the income statement will affect the profit. So if you've got two entries, for example, affecting motor vehicles and cash, that would have no impact whatsoever on the income statement and therefore the profitability of the business. What we're going to look at now is the other thing that could be affected by an error, and that's the statement of financial position. And this is a relatively easy one. The most common one in an exam question, so that's what I'm going to focus on, is the impact on something called working capital. Working capital is the difference between your current assets and your current liabilities. So in this case, the business has $10,000 in total of current assets, $5,000 of inventory, $2,000 of trade receivables, and $2,000 of other receivables. That's money that it's due for some other reason besides it being linked to a sale, and it's also got some cash. And this business has got $6,000 of trade, $6,000 correction of trade payables, $3,000 of other payables that it needs to pay in the short term. And it's also got an overdraft of $4,000. So if we look at this business has actually got a little bit of trouble because it's got $10,000 worth of cash or things that they should turn to cash within the relatively short term. And against that, it's got to find $13,000 to pay people. So it's got a negative working capital or net current assets of $3,000. So your working capital is the difference between your current assets and your current liabilities. And what you will see in some of the older exam papers, you'll also see it called net current assets. The two terms are interchangeable, they mean the same thing. It used to be one of the things that had to be shown on the old statement of financial position, which was called a balance sheet. It's no longer called a balance sheet now, it's now called a statement of financial position, and it's not shown because your current assets and current liabilities go in different halves of the statement of financial position, but it's still relatively important for a business to actually know what its working capital is. And for most businesses, it's important that you've got more money about to come in than you've got going out, because otherwise you may have a major problem trying to pay your creditors or the people you owe money to. So for this business here, we've got a couple of changes that have been made. I'm going to see how they impact on the working capital. Do they increase it or do they decrease it? First one is cash receipt from a credit customer, A. Davis, for $550 after he's taken a cash discount of $50, and it's been omitted altogether from the books. So, first one, quite obviously, okay, he's got a debit entry of $550 should go into this account because we've got more cash. So on the face of it, that's going to increase the working capital. This business has also got a cash discount that's been allowed to the customer of $50. Now, if we look at that, it doesn't go in the working capital section because it doesn't go in the current assets or the current liabilities. And that's actually going to go in as an expense in the income statement. So that bit's going to have no impact on the statement of financial position at all. But what's going to happen is the amount of money the business is owed by A. Davies as trade receivable is going to decline by $600. So trade receivables are going to go down by $600. Cash is going to go up by $550. So what's actually going to happen is the total of the current assets is going to fall, and it's actually going to make the working capital position of this business even worse by $50. So it's going to decrease the working capital. Next one, a bank loan of $10,000 was received. And first of all, the obvious thing is the bank overdraft is going to disappear, and they're actually going to have $6,000 in the bank after this transaction has taken place, because bank loan and bank, don't forget, are two separate items. So in his current account, there's going to be an increase of $10,000. So that bit looks like it's going to increase the working capital. But what about the bank loan? Bank loan is going to be a liability, so we need to put a credit entry in. Okay. But what we need to remember about the bank loan is it's not a current liability, it's a non-current liability. It's going to be paid off at some point in more than 1 year, or will normally be paid off in more than 1 year. So the bank loan itself isn't actually going to have any impact on working capital. So there's going to be a $10,000 increase in working capital because of the bank loan. So the overall impact is going to be an increase of $10,000 and a decrease of $50. So overall, there's going to be a $9,950 increase in working capital. So the working capital of the business now will be $6,950. So now it would appear like this business is going to have sufficient money to pay its current liabilities, and therefore is far more likely to carry on trading in the future. Okay, you should have already done the student question on doing the impact on profit. Okay, underneath that you've got a couple of questions there where you should be showing the impact on the working capital of a business. So I wish you luck with that, and that covers it until any questions on this in the classroom. And don't forget, when you're working through the questions, don't forget to work through the journal entries as well to make sure that you're happy with everything that gets affected by the transaction. Good luck, and I'll speak to you soon. Bye-bye.